Hey everyone, I'm Jordan Wright, co-founder and CEO of Atomic, and today I'm sitting down with Rex Salisbury, founder and GP of Cambrian VC, here at SF Fintech Week for our series, The Action Layer, which is about the gap between where fintech is and where it actually changes people's lives. Rex built the fintech practice at Andreessen Horowitz before going out on his own to launch Cambrian, a pre-seed and seed fund with one of the strongest fintech founder communities in the country. Rex, it's so nice to be with you. Thank you for joining us today for this conversation. Before we get started into the actual questions itself, I first, if you don't mind, taking a minute to introduce yourself, and then I want to talk about another topic before we jump into the questions we have prepared.
So Rex Salisbury, founder of Cambrian Ventures. I'm a solo GP focused on fintech investing. I've been doing it now for 4 years independently. Prior to this was at A16Z, then an engineer, and a long time ago, an investment banker.
Congratulations on the success so far. So Rex, I want to say 2.5, 3 years ago, I teased you a little bit on LinkedIn that why I went to Utah to start a fintech. And at the time, there was a trajectory or a thought about San Francisco that it was coming out of COVID was struggling a little bit. But it seems to be coming back very strongly. And this morning, I was thinking about our conversation. I was thinking about the young and foolish think trajectories are permanent. The older people I'm around that have been more successful, longer years of living, realize that trajectories are not permanent and that they change. How do you think San Francisco has changed in the last few years? And I mean, I think you're a longtime supporter of San Francisco. I think you love the community here. All these things true. Mm-hmm. So what have been your thoughts there? What have you seen change, and what are you excited about for the future of San Francisco?
So I think San Francisco has always been a boom and bust town all the way back to the gold rush. But during the dot-com boom, during lots of other periods of time. So this is not unique for San Francisco. But San Francisco has always attracted dreamers, people who want to do things differently. But I think that's one of the reasons why San Francisco's hit so hard during the pandemic. If you tell a whole bunch of people who are like creative and open and love new experiences, hey, you can go work remotely anywhere. People in San Francisco took that up. I have friends go, to all over Latin America, Europe, just all over the world and all over the country. And then after about 3 years, AI happened. And so that's definitely a thing. We have more, multi-trillion-dollar companies. If you just drive up and down the 101, than you'll find anywhere else in the world. So that's one. The ecosystem is just incredibly deep. But then as those people started traveling the world, coming back, they realized, they actually really like San Francisco. 3 years, like, okay, maybe it's time to come back, see what's going on here. And then also a lot of credit to our current mayor, who's doing a lot of great work in terms of just basic things around public safe, healthy, keeping the streets clean, and doing so with like a really great posture. He's like super active. He's very engaged in showing what he's doing, walking around the city, making videos all the time. And his rhetoric is unlike a lot of political it's just like very balanced, measured, and like focused on doing things. And so it's super refreshing to see both how effective it is, but also the kind of rhetoric and approach that he's taken. So thanks to Mayor Lurie.
Awesome. That's fantastic. Thank you for sharing. And I'm excited for you, and I'm excited for San Francisco. Coming out here for my first time, for the first company I worked at, cybersecurity company, I remember one called Proofpoint that IPO'd from Palo Alto area. But I just remember being captivated by the city and by the excitement and energy here. And just great to see it. But yeah, thank you very much. Okay, so diving into you. So you left A16Z to start Cambrian. You're focused on what is kind of like a 1,500 person founder community-ish. What's Cambrian betting on right now? And why is this a moment? And specifically this moment I think is important in the conversation because AI has I've had a lot of conversations with people in the last, I want to say, 6 months about the impact of AI on new startups, the impact of, so like your earlier stage, typically. What are you seeing about this moment in fintech that excites you? What are you betting on right now?
So I think the biggest thing in fintech is if you look at some of the most successful private tech companies, some of the largest ones are fintech companies. You got the Stripes, the Revoluts, the Coinbases, the new banks. But then if you look at the overall market for financial services, we're still about 1%, maybe now 2% penetrated. If you drive around San Francisco, you'll see a Stripe billboard that says like they power now 1.6% of global GDP. And if you think about financial services revenue generally and you aggregate it across all of the privately funded fintech companies, it's probably 1% to 2% of global financial services revenue. So what that means is 98% of the opportunity still exists. So some people are like, oh, fintech is late, it's over. It's like, well, no, sorry, like we literally only have like 1% to 2% of the market. And so you're like, okay, well, what about this moment makes the other 98% accessible? And I think there are two really big things. One of which is just the talent network and density. If you went back 10 years ago and you're like, hey, how do you build a neobank? Almost no one knows how to do that, or no one knows how to do it successfully because they haven't actually been successful yet.
Yeah.
Whereas today, you can go and you can hire alumni from Stripe,
Absolutely.
Coinbase, Brex, all of these companies who have done it maybe not at once, but 2 or 3 times across 2 or 3 different companies and have a really rich understanding of how the entire financial services ecosystem works. And they're tech native. It used to be if you started a company, maybe you understood tech, maybe you understood finance, but you did not understand both of those things. So that's one, is the talent is way, way, way better than it used to be. And then 2, there's the whole set of infrastructure that you have pre-AI that makes building products and services a lot easier than it used to be. One is just the institutional knowledge held by individuals, but then 2 is the actual APIs, the banking partners, the KYC, KYB, all of that kind of stuff didn't used to exist. And then 3, and this is where I think one of the things you want to talk about too, is AI. Like right now, the types of things you can build and how you can be ambitious about the types of product you build has never been higher. If you wanted to start a multi-product company from day one, 5, 6, 7, 8, 9, 10 years ago in fintech, it's like, oh, good grief, like good luck. That's almost an impossible undertaking. It's so hard just to get a debit card live. Today, if you want to build, a vertical SaaS app that does everything for a specific category of one kind of SMB, that is totally doable with the right team and the right capabilities. And so that means that we now have this new tech wave that's going to unleash this huge rebundling within financial services. So again, we're 1% to 2% penetrated. We have better talent than we've ever had before. We have better like pre-AI infrastructure that just provides connectivity into the whole financial services ecosystem. And now we have AI, which turbocharges that, put it all on steroids, makes it better to build multi-product companies from day one. I think one thing in terms of understanding what that looks like is you're also now starting to see a little bit of cracks in the incumbents in a way that was not true for the first 10 years in fintech's history. There's this quote from Jamie Dimon from like the 2015 era. It was like, watch out, the fintechs are coming. And then if you fast forward 10 years, basically nothing happened.
Yeah.
Like fintech went from 0 to 1%, which we have, Stripe's worth over $100 billion. That's a great outcome. But if you're Jamie Dimon, it's not like the fintechs showed up and stole the customers you care about. But now if you start to look at some of the incumbents, I just posted about Intuit yesterday. Their shares are down about 50% year over year. Why? TurboDex is their flagship product. I think it's something around maybe a little bit less of 50% of their revenues and maybe about 60% of their operating profits. They don't disclose that or break it out publicly. But TurboTax is a huge franchise. Tax prep is becoming free. And how do we know this? Because there are tons of companies who are offering it for free. Chime is offering it for free.
Correct.
OnePay is offering it for free. April is powering a lot of these platforms. And so what you're seeing is someone like Intuit went from having this incredible franchise to one of their core products is now existentially threatened and is being rebundled in for free by a lot of the fintech upstarts. So fintech went from this marginal thing to, oh, actually, we'll take your core customer by offering your core product for free.
I know.
That's completely new and scary.
It's brutal, right?
Yeah.
But the interesting thing I would add to that is that it's free, right, to the consumer, but Chime is still paying for it. These other companies are still paying for it. The opportunity that I felt like Intuit missed was to rebundle that service in other places. And I mean, obviously, April, Column, some of these others have gone a long ways using AI or machine learning to be able to improve the process of filing, decrease costs associated with it, and then go offer it.
And that's almost more terrifying, the fact that it is free to the end user, but not free to the company.
Yes.
Because that means the company is monetizing in a completely different way.
Totally.
So if you're into it, you're like, well, shit, like I can't give it free. That is my business. I don't have, to your point, you would have to have gone back in time 4 years and re-architected the business to be some kind of consumer super app.
Yeah.
Now, arguably, maybe they could have. They acquired Credit Karma. Credit Karma was one of the biggest exits. They have like 100 million monthly active users. Credit Karma has this incredibly rich engagement loop where people like checking their credit scores. They like getting new credit cards, but it never really evolved beyond that. It is still just a place you sometimes check your credit card or sometimes check your credit score and sometimes get a credit card. At one point, they had Credit Karma Banking, and people forget, but they also had file your taxes for free. So Credit Karma Tax, they actually had to spin that out as part of the acquisition.
Yeah, that's right.
Because the Department of Commerce was like, look, antitrust concerns if the owner of TurboTax, Intuit, now also owns and kills a free tax product. So Credit Karma Tax is now inside of Cash App and is powers Cash App's free tax offering product. But the idea that you would have to take someone like Intuit and rebuild it into a consumer fintech super app, like that's just a lot of internal change management. It's a lot of politics. It's a lot of infrastructure and integration.
It's also seeing something really clearly long before it happens to you. That's hard.
Yeah.
Yeah.
Like imagine trying to do that and, killing the golden goose. And ChatGPT, does it exist for another 3 or 4 years? It's so hard.
Yeah.
I think what we're going to start to see is canaries in the coal mine for like a few incumbents starting to feel the pain. And it's going to be twofold. It's AI is going to be commoditizing some of their core products. And two, these, at scale fintechs are going to start bundling in things in ways that are just very hard to compete with them directly.
Yeah, I want to just double down on, as you were talking through those points, I 1,000% agree with your point on talent. It's amazing to me that I can look at 20 people that have done all this before more than once, right? So twice, right? So, and you see them moving from place to place. And we work with most large fintechs, we work with most large banks, and we see people moving between these. And it's like, man, these people have done it again and again and again. And to your point, I think one of the biggest weaknesses in the neobank model right now is still remains partner banks. You can go work with a Galileo or a Marqeta or any one of these, but partner banks still
You've also
move.
got Column in the Presidio in San Francisco, Erebor, which is a newly chartered institution.
Yeah, and so that's a good point on Column, right? Because there's some acceleration there probably compared to how most of these sub $10 billion banks work. But man, that's been interesting for me to watch the speed. So are you saying in your viewpoint, never a better time to start a neobank? Because I also have this opinion. I look at some of the neobanks that are established. I look at the Earnings, the Alberts, all these sorts of groups. Like there is some staying power, I think, in those groups, and I think that they've done a really good job. It would be difficult to outseat some of those right now, I think, from my opinion. I've wondered, does a new Chime start in 2026 or not?
I would never say never, but it has been very, very hard to start a new, like, truly super app in the U.S. Like, Nubank is a super app in Brazil. I think over 60% of Brazilians have an account. It does a lot of different things beyond just the credit card that it started with.
Yeah.
And it did that, relatively early in its history compared to some of its U.S. peers. If you look at the U.S. companies like Chime and Robinhood and other folks, for many years in their journey, they were still mostly just one product. For Chime, it was a bank account with a debit card. For Robinhood, it was free stock trading. Now they've become multi-product companies, but it's taken a long time to get there. I think you also, what happens
to your point about rebundling, by the way, because all of them are having to do this now. Yeah.
And I think they are, and this is your point, like, is there an opportunity for a new, I think there probably is. I like to come with a prepared mind. I like to think I understand a lot about how financial services operate, but I now know, like, there are so many people who spent so much more time building stuff in fintech than I have that I rely on my degree of network connectivity to find interesting people who teach me interesting things that I haven't, like, fully understood myself before. But when they showed to me, like, oh my God, you're right. That's super interesting. So in terms of, should you be starting a neobank right now that's some sort of new super app in the US? Maybe. I don't know exactly what the right, 3D chess is to what that looks like. But I will say, and this is what you were getting at, some of the scale players are starting to do it. So Chime is trying to move up market from, most of their customers are in less than $30,000, honestly, probably even less than $20,000 a year. They're trying to move up to folks who are closer to the middle class, not quite the mass affluent. They define in their S1, their target market is anyone earning up to $100,000. But they've just recently released a secured card, and they're starting to move into actual credit beyond, like, get your paycheck early. So from these kind of, payday adjacent customers who are incredibly cash constrained, moving a little bit up into higher credit-worthy customers. But I think the most interesting one to watch is Robinhood, because Robinhood is the only one who is at scale, is starting to take share in the mass affluent segment. And the mass affluent segment is the biggest segment in which the big five banks tend to make money. And mass affluent is folks who earn households that earn up to like $250,000 a year. So it's kind of like upper middle class, essentially. And if you go back and this is a point about how long it's taken, if you go back just 3 years and you're like, how many mass affluent customers does Robinhood have? The answer is something like close to 0. And if you look at someone like Chase, like how many mass affluent customers do they have? The answer is, well, they disclose they have 60 million monthly digitally active users. And most of them are like close to mass affluent. So maybe it's 50 million, something like that. So tens and tens of millions, and Robinhood has 0. If you fast forward to today, what you'll see is that Robinhood Gold subscribers, which includes a 3% cashback credit card, a high yield checking account, and yes, the free taxable trading stuff, as well as retirement accounts, has over 3 million, I think now over 4 million users. And I think that's a good proxy for someone who is roughly mass affluent. And you can understand to be a bit of a proxy because if you look at their average account balances, they've gone from hundreds to 1,000 to now like several $1,000s. And you look at the average account balance being transferred in, last time they disclosed it, it was about $80,000. So that is a customer, an $80,000 account is coming from somewhere.
Yeah.
And it is a customer that one of the big five banks would be very happy to be serving. So for the first time in the history of fintech in the last 3 years, you actually are seeing, if not regrettable churn, where people are leaving the big banks, which I think that is happening, you're seeing customers mature and get to this place where the big banks would love to serve them as customers, but they never showed up. And that's super interesting. And they're competing orthogonally. Like Robinhood's like, we'll do free trading. We'll monetize on order flow. We'll monetize on prediction markets.
Yeah.
A lot of people find the way in which they drive trading to be distasteful. But if you're an incumbent, that's incredibly hard to compete with. If you interact with the mobile brokerage apps for a lot of the incumbents, they're not nearly as sleek or engaging or entertaining as Robinhood, which means your ability to drive engagement and constantly cross-sell products like retirement accounts, credit cards, a gold subscription, you're just never going to be as good as Robinhood is at it because they grew up in the mobile era.
Yeah, and I want to ask a quick question on this, Rex. So you're mentioning Robinhood a ton, which is a great shining example of so many things. Wealthfront is another one that plays in this more mass affluent space, I think. What are your thoughts on comparisons with the two?
They've got about 1 million. I think what is the current numbers? I should know. I think closer to 1 million in terms of their average account balances are much higher.
Yeah,
they're great company, great product. They are now launching mortgage. So this is actually probably the biggest test for Wealthfront is happening right now. So Robinhood already has the 3 million, 4 million folks.
And they're also done a great job multi-product.
Are using multiple products,
totally
right? They've moved from just the trading into the card, into the high yield account, that sort of thing. Wealthfront manages your assets. Their average client has higher assets, but Wealthfront has very low fees, which means it's harder for them to monetize. The crazy thing about Robinhood is off of an account balance of a few $1,000s because of how much they make from payments for order flow, they actually monetize a $5,000 account to the same extent Wealthfront would monetize like a $50,000, $60,000, $70,000 account, which is kind of crazy, right? If you think about it.
Yeah.
And so that's what's been hard for them. Even though they have a higher caliber customer, they have fewer of them, and they monetize like a low balance Robinhood customer, and they haven't yet done a new product. So I think the big test for them is going to be mortgage, and mortgage is going to be super interesting because that is a great product that serves their core demographic. A lot of Robinhood's users are probably not getting mortgage, but they have so many of them that in absolute numbers, both of them are starting to play around in mortgage. And they just announced their very first mortgage closing in August last year, and they're starting to ramp it now, I think, in Texas, and soon they're going to launch California. But this is another point of where are we in the journey of companies that have been around for a while starting to rebundle. Wealthfront, I believe, was originally started in around 2009, originally as Kaching, and now they're in their 15th year. And they do have some other investment products, like Cash Account was their big second product. But I mean, cash doesn't feel like a high-yield cash account doesn't feel like a completely different product from an investment account. A mortgage is pretty different. And they're trying to offer the mortgage with best-in-class rates that are about 50 bips inside of what you'll find in the primary mortgage market survey that Freddie publishes. And so that's an example of them trying to have a new product and bundle it into the existing. And mortgage is a huge, I guess this is the other takeaway. Whether or not Wealthfront does it well, whether or not they're one of the ones who figures out how to bundle in mortgage, I think someone is. And mortgage, there's north of $10 trillion in mortgage debt outstanding.
Yeah.
It's a huge part of the large banks' franchises. It powers huge independent companies like Quicken or Rocket. And what is starting to happen is that's starting to show up and get bundled in other places. And so I think mortgage is one of the areas to pay attention to. And the reason for that is if you go back, my first company that I helped build and was a software engineer at was a company called Cindio. They're actually, literally, their offices are like 100 yards from where we're recording this. And we were working on automating mortgages about 10 years ago. And it turns out pre-AI, it's really hard to automate mortgages.
Totally.
It's a lot of emails. It's a lot of PDFs. It's a lot of back and forth. It was a very, very hard, computer vision problem to do OCR, to extract data from a pay stub. That now is a trivial problem.
Correct.
For folks. And you can also intermediate a lot of client communication. So the average mortgage costs about $10,000 to originate, which is crazy. That number has just kept going up.
Yeah, that is crazy.
And for the first time, I think what we're going to see is that tech can actually automate a lot of the process we have around mortgage and drive the cost down, which means it's going to be easier to bundle in, and it's going to be easier for someone like a Wealthfront or whoever else to give more economics back to the user and offer it as part of a broader bundle. Like that's what we were talking about with tax, is someone's like, why don't we just give people taxes for free? Like that's fine. And what you're going to see with mortgages, someone's going to be like, why don't we give people, you can't give someone a free mortgage, but you could probably, if you have an existing relationship with them, give them the best rate they're going to find anywhere. And the sad reality is if you're the customer of a big bank and you go to them and ask for a mortgage, oftentimes they know that you're not shopping around and they'll give you a worse rate than if you had gone to a broker who originated a mortgage product from Bank of America. So if you're a Bank of America customer and you want like the best rate for Bank of America, don't walk into a bank branch. They'll give you a worse rate.
Yeah.
Like that's a crazy.
It is a crazy
That's
idea.
how our mortgage system operates. So I think mortgage, like we're so early, like the numbers aren't really there. But when that shoe drops, it's going to be a massive thing. Because, the free tax thing, it's basically TurboTax. They have huge market share. Stuff like mortgage, when you start bundling that in and changing the logic on how people think about economics as part of a more complete product bundle, that really impacts a tremendous number of institutions. So that's one of the things I'm really excited to watch happen.
So that's one thing, Rex. What other things do you feel like we're under-investing in right now? And because some VCs approach it as a thesis-driven thing, right? Like this is what I think is going to change, right? Sounds like you also have this approach, which is, hey, I don't know where the best ideas are going to come from, but I have to really, really good at spotting them from my perspective. But do you have views on here are the most underinvested things right now?
So I have to invest. I wouldn't say that I'm anti-consensus. I don't think anyone can be totally like non-consensus, especially as a pre-seed or seed investor, because one of the biggest risks you take as an investor on is follow-on financing risk. The reality is most companies are not one and done. They need to raise again. And so if you're too far outside the window of what's investable, they'll run out of money before they're able to prove out, the thesis behind the company. But what you can be is a little bit pre-consensus just by being closer to the market and to the founders who are teaching you what new opportunities exist. And so that's my goal, is to just spend a lot of time talking to smart people and talking to lots of smart people to understand what's possible and why it's possible.
Can we talk about that point real quick? So the founders that you're spending time with, learning from, and having these conversations with, what is it that allows them to be close enough to have the insights from your perspective? And I might share a couple of thoughts here too, but what is your thought?
Well, one, I mean, like someone like you went back and you had this experience building Unbill, and that taught you a whole lot about lots of different parts of the financial services ecosystem. And so then when you started Atomic, it gave you, and then you were at ClickSwitch, and then you were at Atomic. Like you had all of these unique experiences that meant you understood things about parts of financial services that other folks had not spent a ton of time in. And so that's my goal is, and your experience, pretty deep, very interesting, but does not cover the breadth of financial services experiences
I'm very
by any means. Right?
vertical in terms of my knowledge.
But there are lots of people who have spent like 8 years in a particular area who are like, the time is now for this new thing, and Rex, here's why it's now, and here's why I'm the right person for this thing. And so that's my goal, is to spend a bunch of time trying to find people who basically are like, look, I've been working on this thing, and I'm like deeply ingrained in it, And usually the why now is like AI opens it up in some way, but it's still something around financial services. And they're like, here's how I'm going to bring that product into market. Here's what the product actually is. Here's the problem that it solves for users. And so that's what I'm focused on is people who've, been building their whole career for a moment where like now this opportunity exists and I know exactly how I'm going to go after it.
Second-time founder versus first-time founder. Do you have a preference?
What I mostly want to see are really unique ideas and insights. And for better or worse, a lot of the things around financial services are heavily permissioned and require insider knowledge and relationships. And so it is very hard to find first-time founders who have unique ideas. Now, I think what you will often find is that the most successful companies are almost always by first-time founders because they're riding such a massive new wave that the thing that they're building for, like other people haven't even spent enough time thinking about. And you can look at that in terms of like Stripe, right? The Collison brothers making it easy to take a credit card online. I also think part of the reason why a lot of big companies have been successful with first-time founders is just the number of founders in the ecosystem. When the venture ecosystem was smaller, there just weren't as many, like, or take fintech specifically. How many repeat fintech founders were there in 2010?
No.
There aren't any.
Yeah, correct.
Right? So you should just naturally expect to be funding more people who have more experience because there are more technologists with experience that understand financial services. And so I would say about 70% of folks I invest in are repeat founders or are serial operators within the broader ecosystem that's relevant to what they're starting. But I still am very excited about backing folks who are first-time founders.
Yeah, it's interesting. So if I look back at my experience, like 2012, starting Unbill, right, selling in 2017, and I feel like there were relationships that were opened up there that made Atomic a lot easier to initially get off the ground. But then I look at it now, and so we work with 9 of the top 10 banks. We work with most large fintechs. I can go to any city that's a financial hub and have a meeting with one of the top financial services companies in the United States. And that's been surprisingly like a huge, because our first product, direct deposit switching, I told all my investors from day one, this is not more than $100 million a year business. It just can't be,
Yeah.
And then 2021 happened and companies that were in our space were fundraising at massive valuations and all this sort of stuff. And I was like, we took less than half the other valuation, even though the other was offered to us, because we're like, I don't think this business that we're in right now can be big enough to warrant that kind of evaluation. But now here we are a few years after that, and we're multi-product across almost all of our customers now, especially all of our large customers. But those insights don't happen. Coming back to your conversation about founders and how those insights get generated, going and spending time with customers and seeing what they're thinking about. The nice thing is most of the top 10 banks in the United States have a fintech arm that their buying groups work with to go and source deals, right? And those fintech arms, they know what their marching orders are at any given point in time. If you're meeting with them quarterly, they're telling you, here's what 2 years looks like, here's what 3 years. It's not always the case that they know that's going to happen. But I mean, we saw the tax thing coming a long way off. 3 years off for sure. We saw the tax thing coming, right? Earned wage access, that one's been coming for a long time, and I think it still hasn't even hit its full stride yet, right?
Yeah, that's the other thing. Like some of these things have been around for 3 years in the case of tax, and you're like, they're just getting started. Or earned wage access has been around for, 10.
Yeah.
But if you look at its penetration, it still has plenty of room to run.
Tons of room to run, right? And so I think staying really, really close to the end consumer, but also to the buyers inside of these financial institutions, it just gives you insights. And then you create relationships over time so that you can go and you can start brainstorming, you can start thinking about what that next thing is. And I would say I'm much more bullish about our long-term valuations, things like that, now than I was in 2021, now that we've successfully become a multi-product company and we see our way into some of these other revenue streams. But that insight would have been very hard for me to feel confident in having back then. Well, this gives us a chance to transition a little bit to the last kind of 2 areas here. So you said you're in about 40 different companies. What's the most common pattern for you where you feel like a founder really understood or had a good understanding of where the market was going or what needed to be built, but they missed? What's the most common pattern from your perspective?
So one, no VC wants to talk poorly of any of their companies. So there are lots of companies I haven't funded.
Totally.
I think. One of the things that's hardest for me, and this is maybe a way in which my taste as an investor has changed, and is in part a function that I now invest very early. I used to invest at Series A at my prior firm. Now I'm really focused on pre-seed and seed. And it used to be if I saw like 4 companies in a single area, I'm like, this is definitely going to be an area I should try and like figure out who's going to win and why.
Yeah.
And now if I see 4 or 5 or more, certainly more companies at the pre-seed or seed, I'm like, I don't have enough time to talk to all these companies, to talk to all their prospective customers, to understand who's going to win and why. And every now and then there are exceptions because one team is just so far head and shoulders above the rest. But usually they're all pre-product, they're pre-revenue because I'm investing at the pre-seed, and it's really, really hard to tell who's going to win and why. That doesn't mean one of them won't. It just means it's very, very hard as an investor to know, as a pre-seed investor, who's going to be successful. And one thing that's also hard about the job is you realize that the buyer is going to be in a similar position. If there are 3 or 4 people who are all building the same kind of thing, the buyer is going to meet with all of them at the same time. And so even at the seed or the Series A, what the seed or Series A investors are going to be doing is basically trying to triage and doing customer references, and all of that is still really hard. So how I have approached that, which is in part just a way of being efficient with your time, but also I think probably does also correlate with the ability of the company to become successful, is trying to find companies that have a unique reason to exist and a unique perspective. And they still might not work out because that perspective might not be true, or the timing might be too early, or the execution might not be up to par. But if it is the right time, and I believe they're the right team, they should have an ability to execute against it. And then when you go and you talk to downstream investors and they hear about what the company is doing and how they're doing it, they aren't, Series A, all investors are incredibly distracted, and there's an incredible amount of noise they wade through. So if you are like telling them about the 4th or 5th company in a category that they've heard about, it can just get very hard for them as well to disambiguate. And so that's what I've settled on, is basically trying to find something that is unique and the founder is uniquely positioned to. I guess the flip side of that is, for anyone who starts a company, the company you start has to be a company that's unique to you. It can't be that you like heard something, it was a good idea. It definitely shouldn't be like, oh, well, that company just raised a Series B. It sounds like investors want to fund it. I want to start that thing. It has to be a story that's like unique and genuine to you and your background and your experience that should lead to you wanting to be in the business that you're going to be in.
Yeah, it's interesting for me because I think a lot of people, when they talk to a successful founder, they think that founder had it all figured out and knew how things were going to work, or that they had a system that made sure that it would work. Mm-hmm. And this is a very common thing that I run across of people that aren't founders. And I look at it and I'm like, you just have no idea how much luck plays a part in this. Timing plays a part in this. It's funny how like here I am as a founder. I've started a couple of companies and I see myself doing this forever. Yeah. But at the same time, I've almost begun to be a little bit antagonistic against my own kind a little bit, because sometimes we have this backwards bias where we look at our success and, oh yeah, here's the things that led to it, right? But I get a little bit frustrated sometimes when I hear people say like, here are the 3 things that lead to success starting a company, and yet I don't know what the percentages are, but sub 5% achieve 10 million in ARR for sure, right? Mm-hmm. Of venture-backed companies, right? So it's like those sorts of things are, I think, hard for people to think that there's not a formula I can follow to success, that it is actually like, yeah, some things will work out, some things won't. You can try your best and you try to capture as much of the luck in your sale as you can. But at the end of the day, you're only trying to capture market momentum, luck in your sale. I don't think, Jobs was 2 out of 7, right? Maybe Elon is the one that can break this, but it's hard for me to find people. So yeah, those bets early on are fascinating to me, Rex, because it's a hard thing to be able to, but the power law helps you on some of that too. Yeah. So anyway, any other thoughts there?
No, but I think one of the things I would also say is, and this is one of the things that makes SF special, is that just because you start a company and it doesn't work out doesn't mean it can't be a great and successful opportunity to build a career. Like, let's say you start a company and it turns out the opportunity isn't that big and it's a feature. Well, so you get acquired and it's not a multi-billion-dollar outcome. Well, who's the company that acquired you? Well, a company that needed that feature. And that company itself is probably a bigger, more interesting company. And you're probably coming in 2 or 3 rungs up from where you might have been hired before. And now have the scope, and especially in the Bay Area, you have the aura of someone who has sold a company and has been a founder. And now you're inside of a larger, faster growing, successful company where you can learn new things about new problems and start thinking about the second thing that you want to build. And so I think that's one of the things that's magic about the Bay Area ecosystem is that the opportunities for founders who build companies that don't work out to actually up-level their career and their capabilities by joining other companies is absolutely unparalleled. Because I have friends in other ecosystems who their company doesn't work out, it shuts down, and they go back to working for XYZ large employer in that area. Whereas one of the things that makes the Bay Area so special and so interesting is that you can use that as an opportunity to go and do other, even more interesting work.
That's such a common, maybe just really quickly, I'll mention this, then we'll jump into our last question. But when Unbill, there was a time when we had a month of cash left and it was very close to going out of business. And I remember calling a former boss of mine, founder and CEO of a company called NextPage. And I was like, who's going to want a washed up founder to hire? I have to provide for my family. It's not working out, all this sort of stuff. He's like, oh, I'd be the first in line to hire you. The amount that you've learned in this process makes you way more valuable than you were when you were working for me, which was an insight I didn't have. It's hard to see that sometimes and have that self-awareness when we're doing it ourselves. But he's like, but I probably wouldn't be the highest paying person either. There's going to be a line out the door for you. And I was just like, who would want that? But as you look back, that is the beauty. And so I said I'm a little antagonistic towards myself as a founder, but also I am hugely for the idea that there's no better education than starting a company and there's no better growth mechanism. At the end of the day, after we sold to Q2, it was a year later, and I was like, my growth is stagnating. It's slower than it was. I don't have the same peer group. My investors, my board, I don't have the same people to spend time with. And that's frustrating for me. And I mean, I had a fair amount of payout still left. I was only a year in, but I was out of there for that reason, right? I just couldn't keep growing. And that's kind of all I care about at the heart is how my growth trajectory is personally. So anyway, it's a fascinating thing. Okay, so last kind of question here, maybe. What actually needs to happen for early stage fintech to move from compelling demos and strong early metrics to companies that genuinely change how people behave with their money? What's your thought here around and especially I think AI related, right? So we're gonna get into, we have some companies looking at how do I actually take action on behalf of a consumer? How do I, PFM, which we both know pretty well from its early attempts, was mediocre, maybe even not successful. But it feels like there's going to be a level of it, I believe, in the next little while that can actually leverage AI to make it much more successful on consumers' behalf. What do you think has to happen for it to get there?
Yeah. I think on the consumer side, what you have to do is you have to give away something of incredible value for free to stand out through the noise of the market. And this gets back to why it's actually hard to start an incredibly successful consumer company from day zero, because usually what that means is you need multiple products to be cross-subsidizing each other in some way that something can stand out and you can give it away for free. That's a really hard, chicken and the egg problem. But if you look at some of the most successful consumer companies, that's what they did. Credit Karma, free credit score. Yep. Robinhood, free stock trading. I think in the age of AI, you have a new opportunity to reimagine some new bundle and give away an incredibly powerful thing for free. The problem is, and this is what we talked about, some of the at-scale fintech companies are already playing around with this. Robinhood has free stock trading. They're going to work on doing free taxes. They're starting to dip their toe into mortgage. Wealthfront is trying to give away compelling economics on the mortgage side of things. Then we talked about all the players you're giving away free tax. So I think that's the hard part is how do you actually stand out if you're a consumer business and give away something of tremendous value for free. And even the incumbents do this, right? When you open your mail, you're not getting any mail. You're just getting credit card offers. And what do those credit card offers say? Free money, free money, free money, free money. That is how you grab. That is probably the most common way in which you grab consumer mind share in the world of financial services is give something away for free. But that means you have to monetize it another way. So that also makes it really hard. But the good news is, I think in the world of B2B, there is a tremendous amount of stuff that you can start to give away for free because AI has approached, or even according to market research, is like, look, AGI happened in December 2025, just not easily distributed yet.
Yeah.
There's all of this automation that you can give away for free and then figure out other ways of monetizing. So I've done a lot of investing in companies that do vertical SaaS for different categories of SMB. And you can be like, look, we're going to automate these aspects of your operations. And oh, by the way, we do payment processing. Oh, by the way, we do embedded lending. Oh, by the way, we do these other things that monetize invisibly. So I do have like a mini thesis around not the exact type of company that will be created, but that a lot of how AI automation gets delivered into the real economy, that automation will be given away for free in a B2B motion where the actual monetization happens through financial services, payment processing, lending, insurance, a bunch of other stuff.
Yeah, we're two consensus on this one, right? Because I agree 100% on this theory because we see it. So like direct deposit switching, financial services companies pay for it. For us, it's free to the consumer. Payment switching, same thing. Subscription management, same thing. SKU level data. So all these things, right? Subscription management is a product Rocket offers at a actually high price point, right? But in the next year or two, we will see most large fintechs in the country have a subscription management offering, and a lot of large financial institutions too. Very interestingly, if you go through globally, Visa is pushing for more requirements on their large financial institutions in markets outside the United States right now. I think it'll eventually come that they have to have a subscription management offering in their product, which is like, that's fascinating that Visa can come in and say, as part of our rule of working with us, you have to have a product like this. By the way, you can use our technology, but our technology.
Is that because they're worried about chargebacks on?
Yeah, and also the whole ecosystem around this is getting a ton of attention. The whole subscription economy, right, and the financial impact on consumers that it is, right? Like that's gaining a ton of regulatory pressure, and largely chargebacks and stuff like that. I think 10 to 15% of all chargebacks are actually tied to subscriptions, right? And so
I'm sure you've had that experience where you're like, I can't kill this thing.
Exactly.
I don't know what else to do.
Right. And so Visa has the ability to put stop payment in place, right? So does MasterCard, right? Both these companies can do that. But then what happens is the person still has a liability. Oh, what do you want? Somebody end up in small claims court over a Netflix payment that was $21 a month. You know, that's like, I don't know how that ends up working itself out. But I think that's something interesting that I'm watching right now trend-wise. Is it's fascinating that it's starting outside the United States from a regulatory standpoint. Not regulatory because Visa's not a regulatory body, even they probably feel a little bit like it.
Well, they mostly are.
Yeah. So, but that's an interesting one for me to watch. Is that globally, I think we'll see a push more outside the United States.
Well, a lot of it is the U.S. is just such a huge market. Like I know Facebook tries a lot of the stuff they want to do in the U.S. in Ireland first because it's like similar-ish, much smaller, safer.
Yeah, that's fascinating. Last question I think here. I wrote something recently. I've been thinking about this idea of whether or not AI embeds banking or banking embeds AI. What is your thought on where that will end? So a lot of people will say, so Plaid had an announcement recently with ChatGPT. You can export your data to ChatGPT and ChatGPT can go handle stuff for you. Yep. I think a lot of people, especially in fintech, have this thesis that ChatGPT, Claude, these sorts of groups are going to embed banking into them and going to become the layer by which you do your finances. But there's another theory out there, which is that what makes it hard for them to just embed AI? And they have more data. You can pull some data out of Plaid, right? But you can't pull everything. They have more data. They have actionability on that data, which Plaid doesn't have, right? Even though they're part of it in the payment space. What are your thoughts on that?
I think I actually do have an answer here that I'm like reasonably confident about, but how it could play out could certainly shift. And again, we'll break down consumer versus business. So on the consumer side, I have kind of a toy thesis that what you want to look for is a reliable income stream that other things can get bundled around. And I think the most stable form of income stream is in and around asset management. And so I think like a lot of people pay a wealth advisor 1% a year to manage their assets.
Yeah.
Oh my God. That is the best business in the world.
Yes.
You do very little work and you clip an annuity and the pool grows bigger through appreciation and contributions every year.
Yeah.
For a long time, if you went to your wealth advisor and you're like, hey, I want you to do my taxes, they'd be like, that sounds like work. It's lower margin than this thing. If I do it wrong, you're going to get upset. We have a guy. You can talk to them. They'll do it for you.
Yeah.
But now if you go to your wealth advisor and say, hey, I want to do my taxes, and the advisor's like, oh my God, like all my clients are asking me this, and this other firm does it. Okay, we're going to start doing that. It's now included. They don't want to do it. They don't want to be the first person to do it, but competition is going to start to pressure them to do it. And they have the fee stream that enables them to start to expand the scope once the cost of doing those things in the expanded scope goes down.
Yeah.
So a lot of the legal work, the tax prep work, AI is really good at automating. The cost of that stuff, as we talked about, is trending towards zero.
They already have the customer.
They already have the customer. It's a really long-lived customer relationship. I think it's just going to slowly get bundled around that core fee stream, and the amount of money earned on those other things is going to go away. And what's surprising is the extent to which this is happening, not just for the high net worths and the ultra high net worths, but for even the mass affluent or the middle class, because you could argue this is what Robinhood is doing. Even with low balance accounts, now the way they monetize is through day trading, not by 1% AUM fees.
Yeah.
But they're still able to bundle a lot of it around the investable assets that throw off reliable fee income. And so I think a lot more is going to get bundled around the asset management experience, certainly higher. And that's what we talked about with, Wealthfront, for example, trying to get into mortgage and get into other products as well. So I think a lot of it is going to get bundled around that core thing.
And it isn't that the AI companies don't win in that. They do win in that case. They just don't own necessarily the customer relationship because you're saying in large part probably stays with who it is with today.
Yeah.
And then from there, the AI companies are in the back end making money off of every single thing.
And another way to think about it is just from first principles, like you're Jordan, I'm Rex. Like we have financial lives. How do you want to manage your financial life? Do you want one bit of software that does everything? Or do you want 10 different bits of software, 5 different bank accounts, 3 different retirement accounts, one PFM that tracks your burn, another one that tracks your net worth, and you kind of go in between all of them all the time? No, you don't want that. What you want is a single thing that does all of those things. But that bit of software needs a monetization engine that can afford to do all of those other stuff and has the right context. And I think asset management is that thing. And then another related thing would be maybe, okay, why don't just Anthropic and Claude do it for you? Mm-hmm. I think it's just too hard for them to maintain all of the connectivity, and they don't have, tokens cost money. They're going to be like, hey, you got to pay us a subscription fee. And you're like, but this person will just do my taxes for free.
Because they can absorb the tokens.
Yeah.
Yep.
And so they can absorb the token spend as part of their model. So I think... So maybe I'm wrong. Maybe it doesn't get bundled around asset management. But what I would say the higher level thing is look for the fee stream that is reliable, that consumers won't object to, and that can support doing more things. And so I think that's what's going to happen in consumer. Then if you go to the B2B world, I think it's the same story. Let's say you run a small business. Do you want 10 pieces of different software that run your business? Do you want a payroll system that doesn't talk to your the other parts of your HRIS and your employee benefits, that doesn't talk to legal, that doesn't talk to marketing, that doesn't talk to advertising, that doesn't talk to your payment portal, that doesn't talk to your CRM? No, that is your least favorite part of running a business.
That's right.
Is that you have these 10 different pieces of software that don't speak to each other. Some of which are really good pieces of software. Some of which are crappy pieces of 1990s private equity backed software.
Yep.
But even if it's good software, you would rather have one thing. And so the same thing applies. Who is going to have a stable fee stream and the right kind of permissioning and placement to be able to expand into doing more stuff? And this is where I think most vertical software is going to trend toward. Some people are like, look, the big opportunity in AI is we're going to automate labor and then we're going to charge as though we're labor. I don't think that's right. I think that misunderstands how economics works. I think what will happen is the cost of that automation will trend towards zero, and we're now going to bundle in a lot of that automation into a new type of thing. And I think how we're going to do that is by having vertical software platforms that monetize through financial services and give you everything else for free.
Yeah.
Because that is an amazing pitch. Hey, Jordan, you run a small business. You have 10 pieces of software you spend $30,000 a year on today. They all work okay on their own, but you hate managing the connectivity.
This is
what if I gave them all to you for free and it was fully integrated into your finance backend?
Yeah.
Great. Let's do it.
This is Ramp, Brivy, Ramp, and Brex and Divvy. right? It was, I'll give you this other piece of software that you're paying for today. I'll bundle into financial services. I do see that.
And this pitch even works for horizontal plays where you do the same kind of thing. You're like, we kind of give away a lot of the other parts of it, but then, give you this thing as well. But so I think that's what's going to happen is a lot of the automation will be, and I'm investing in companies that are doing, vertical SaaS for private aviation, for optometry, for like other sub areas. And I think it's because they're going to monetize through financial services and they're going to be the person who has the right to like step into doing a lot of the automation.
Yeah, that makes sense.
And is able to cover the token spend that's requisite in doing that.
Yeah. Well, Rex, as usual, it's been so nice to spend time with you. Thank you for taking the time to chat with us today.
You bet. Thanks so much for having me.